In recent months, we have witnessed a phenomenon that has puzzled many analysts. Gold has reached new all-time highs, surpassing $3,700 per ounce. At the same time, U.S. real interest rates, that is, Treasury yields adjusted for expected inflation, remain at elevated levels. Hi, I'm David, a financial analyst with over 30 years of experience. Today, I will discuss the decoupling between gold and real interest rates. Historically, as you can see from the chart, gold and real rates have had a well-defined relationship. When real rates rise, the price of gold tends to fall because holding gold becomes relatively less attractive compared to securities offering a positive real return. In theory, higher real rates should make gold less attractive, as gold generates no interest, unlike bonds. The fact that gold is rising despite high real rates signals that other market forces are driving this balance. Since 2024, however, this classic pattern appears to have broken down. Let's take a closer look at why this is happening. What is gold-real rates decoupling? The term decoupling refers to the disconnection or loss of a historically stable correlation between two variables, regardless of whether that correlation was positive or negative. In the case of gold, for decades, its price has been modeled based primarily on U.S. real interest rates, calculated using TIPES, Treasury Inflation-Protected Securities, inflation-indexed U.S. government bonds, or the break-even inflation rate, which reflects the market's expected inflation rate. The break-even rate is derived from the difference between the nominal Treasury yield and the yield on TIPES of the same maturity. Dollar strength, another key variable, historically inversely correlated with gold. As with all commodities, a stronger U.S. dollar typically makes gold more expensive for buyers using other currencies, reducing demand, while a weaker dollar has the opposite effect, supporting gold prices. This relationship has long made the dollar index a crucial indicator for gold traders. The breakdown of the correlation. From 2024, gold gained over 80%, breaking through major psychological thresholds. First $3,000, then $3,500 per ounce. Meanwhile, the 10-year TIPES yield has held steady at around 2 to 2.2%, levels that in the past would have exerted heavy downward pressure on gold prices. This marks a clear decoupling from real yields, with investors increasingly treating gold as a strategic portfolio hedge, less dependent on traditional interest rate cycles. The historical link between gold and real yields has therefore temporarily broken down, driven largely by central bank purchases, institutional demand, and heightened geopolitical fragmentation. Record central bank purchases. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2024. China, India, and other emerging markets are leading this diversification strategy away from dollar reserves. This demand is inelastic. Central banks buy regardless of price, establishing a structural floor in the market. The chart highlights how central banks ramped up their gold purchases from late 2022, setting the stage for the record demand seen in 2024. Institutional risk and the Fed. The aftermath of the 2024 U.S. presidential elections and rising political tensions have raised concerns about the Federal Reserve's independence. Goldman Sachs, cited by the Financial Times, warned that less orthodox monetary policies could push gold towards $5,000 per ounce. This political premium, the risk premium investors assign due to political uncertainty and questions over the Fed's independence, is something traditional models based solely on real rates failed to capture. This is significant because it shows markets are starting to price political risk into gold, something we rarely saw a decade ago. Dollar weakness and global fragmentation. This chart shows how, despite a shrinking European central bank balance sheet, the price of gold in euros continues to rise. This signals that gold no longer simply reflects central bank liquidity or real rates, but responds to structural factors such as geopolitical fragmentation and the search for alternatives to the US dollar. At the same time, gold has overtaken the euro as the world's second largest reserve asset, highlighting not only partial de-dollarization, but also a structural shift in global reserve management, with central banks diversifying away from traditional currency holdings. I believe this illustrates a slow but steady rebalancing of the global monetary system, with gold regaining credibility as a neutral reserve asset. ETF flows and Asian retail demand. After years of steady outflows, gold ETFs have finally reversed their trend, signaling renewed investor interest in paper gold. At the same time, physical demand in Asia, driven by strong appetite for bullion and jewelry, continues to rise, further tightening supply and supporting prices. Practical takeaways. Today, the gold market is driven by structural rather than cyclical factors. More specifically, persistent official sector demand and geopolitical tension. Central banks, especially in emerging markets, are buying gold at record levels regardless of price, while global conflicts and instability have strengthened gold's role as a safe haven asset. Political and institutional risk in the United States. Concerns over the Federal Reserve's independence and shifts in economic policy have added a political premium to gold, influencing prices beyond interest rate dynamics. Dollar weakness and the search for neutral assets. With growing de-dollarization efforts and fragmentation in global finance, investors and central banks are seeking alternatives to the US dollar, further supporting gold demand. The gold real rates decoupling shows that old models based solely on TIPES no longer suffice. For trading, in addition to monitoring global monetary policy and inflation data, traders should track central bank gold purchases, official reserve flows, and geopolitical risk premia. These forces have become increasingly important in shaping gold's behavior. Reducing the relevance of traditional rate-driven models, market sentiment and shifts in the Fed's narrative can trigger sharp price moves in either direction, even when macro data appear stable. For asset allocation, gold has long been a portfolio diversifier and a form of insurance against inflation and systemic risk. Today, its role has broadened. It now reflects concerns over currency debasement, political shocks, and structural changes in global finance. More than ever, it is crucial to protect portfolios by allocating part of investments to gold, particularly through specific ETFs, given the heightened risk of geopolitical escalation. From the Russia-Ukraine war potentially spreading to other countries, to Israel's recent missile strike in Doha. Simply put, gold is no longer just a thermometer for real interest rates. It has become a barometer of global risk. In my opinion, this shift marks a turning point for gold. We are moving away from a market driven mainly by interest rates to one that reflects deeper geopolitical and structural forces. For investors and traders, this means gold should no longer be seen solely as an inflation hedge, but as a core strategic asset, a form of insurance against systemic risk in an increasingly unstable world. Of course, gold's trend will experience pauses and natural pullbacks, as is typical of any market. However, this shift in gold's role is here to stay, and its importance in both institutional portfolios and household savings is likely to grow even further over time. Thank you for watching. I hope today's insights will give you a sharper edge in your trading and a deeper understanding of the markets. I would love to hear your thoughts, so please share your feedback in the comments below. If you would like more in-depth content on trading strategies, market and macroeconomic analysis, and global finance, make sure to subscribe and turn on notifications. That way, you will never miss my latest videos, all designed to help you grow as a trader and investor. Thanks again for your time. See you in the next video.